Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's just jump right in. $8.65 to $9.59. That's the intraday trading range we're watching right now for WKEY, ticker WKEY. But honestly, the price action, it's almost secondary today. The real headline is the volume. On January 14th and 15th, we saw this massive liquidity event. Volume spiked to nearly 260,000 shares. That's almost double the 90-day average. Something is moving this stock, and the numbers, well, they imply a dislocation that's almost hard to believe. You're looking at a microcap company, market cap somewhere between, say, $100 and $122 million, yet it is sitting on a consolidated cash position of $228 million.
Hold on. Let me stop you right there. Because while those numbers sound fantastic in a vacuum, you have to look at the plumbing. You mentioned the volume spike, but have you actually looked at the bid-ask spread? In the thin trading hours just this morning, we saw ask sitting as high as 10.27 against bids all the way down at 7.85.
It's volatile, I grant you that.
It's not just volatile, it's a liquidity minefield. That spread tells me that while you see a value anomaly, the market makers see a structural risk. It suggests this isn't just a mispriced asset, it's a trap. The entrance is wide open, but the exit door is the size of a keyhole. You simply cannot move size in this name without getting seriously hurt.
I appreciate the liquidity concern. I do. And yes, it's a thin stock, but that volatility is exactly where the opportunity lies for the patient investor. We are essentially looking at a sum of the parts play that is, well, it's mathematically undeniable. WKEY isn't just a cybersecurity firm anymore, it's a holding company. When you strip it down, you have that massive cash pile, and then you have the controlling stake in SEALSQ, ticker LAES. With SEALSQ valued near $800 million on the NASDAQ, WKEY's stake alone implies a value of roughly $416 million.
On paper.
Let me finish the math here because it is staggering. That stake is nearly 4 times WKEY's own market cap. This is a classic negative enterprise value situation. The market is effectively paying you to own this stock. You buy the company for $100 million, you get $228 million in cash plus a $400 million equity stake for free.
Or the market is telling you that the parts aren't worth the sum because they're locked inside a governance labyrinth. I call this the control discount. You have a dual-class share structure where the CEO, Carlos Moreira, holds all the voting cards. Minority shareholders are just passengers on his ship. And about that SEALSQ stake, you keep quoting the market value, but it's paper wealth. WKEY cannot liquidate a $416 million position in LES without crashing that stock to zero. It's totally illiquid collateral.
They don't need to liquidate it all at once to realize value.
They might not be able to realize it at all. And frankly, the market is terrified that the $228 million cash pile isn't going to be returned to shareholders. The fear is that it's going to be burned, specifically on this big pivot to quantum hardware, which we definitely need to discuss.
I see why you think that, and the burn rate fear is common in deep tech. But let me give you a different perspective on the strategy. It's called convergence. Management isn't just sitting on the cash. They're actively restructuring to unlock it. They are redomiciling to the British Virgin Islands, the BVI.
Which raises its own eyebrows.
It raises eyebrows if you don't understand the Swiss Code of Obligations. Swiss law makes capital returns incredibly difficult and slow. The move to the BVI is designed to gain flexibility for distributions. They are spinning off the space division via a SPAC. And yes, they are acquiring Quably to integrate post-quantum cryptography. This is a deliberate roadmap to dismantle the very discount you are worried about.
A roadmap is fine, but execution is everything. And right now, the execution risks are screaming in the data. Look at the short signals. On January 12th, we saw a spike in non-exempt short volume.
Which is often just market-making activity.
No, non-exempt is different. For listeners who don't watch the plumbing, that means traders were aggressively hitting the bid, maybe without even locating the borrow first. They were betting against the stock even as prices were falling. That is high conviction bearishness. They are not buying your arbitrage story. They are betting the governance structure breaks before the value is ever realized.
Okay, so let's dig into the specifics of that value realization, because the most immediate catalyst is happening right now with the ysat.space spinoff. This merger with Columbus Acquisition Corp, ticker COLA, is set to value the space division at $250 million. WKEY retains about 90% of that, which puts another $225 million asset on the balance sheet. This isn't theoretical anymore. On January 14th, the SpaceX transporter mission successfully deployed the latest YSAT satellite. We saw the volume spike correlate perfectly with that launch.
And that is exactly where the trap is set. You are hanging your hat on a SPAC valuation in 2026. Have we learned nothing from the SPAC bloodbath of 2023 through 2025?
The market conditions have stabilized since then.
Have they? A $250 million valuation on paper means absolutely nothing until the de-SPAC trade settles. We've seen countless examples where these things list at $10 and trade down to $2 within months. Remember what happened with some of the other satellite constellations? If the Columbus acquisition deal closes and the new ticker drops to $2, that $225 million asset you're celebrating, it evaporates. It just becomes a line item impairment.
I'm not convinced by that, because you're ignoring the technical validation. This wasn't a paper launch, it was a physical one. The SpaceX success moves this division from PowerPoint risk, where you're just selling a slide deck, to operational risk, where the hardware actually works. And interestingly, I want to bring in a unique data point here. If you look at alternative data sources like Polymarket, the sentiment tracking for SpaceX launch cadence was over 90%.
Wait, you're correlating the stock with a betting market?
Absolutely. The market knew the infrastructure was sound because the prediction markets were pricing in the launch success. The volume we saw on the 14th and 15th was the equity market re-rating the probability of the deal closing. Even if the SPAC trades down to $5, heavily discounted from the $10 NAV, it's still massively accretive to WKEY's current price.
But does that value actually get to the shareholder? That is the question. You mentioned the BVI redomiciliation earlier.
Sure.
The British Virgin Islands Business Companies Act makes it easier to distribute dividends than Swiss law. But easier doesn't mean guaranteed. WKEY can distribute 10% of the SPAC shares to holders, but they're not obligated to. The bulk of that value remains locked in the holding company, under the control of management.
But management owns a significant chunk of equity. Their incentives are aligned.
Are they? Or are their incentives aligned with building an empire? And let's be honest, moving to the BVI creates a massive ESG risk. It reduces transparency. Why do you think Morgan Stanley cut their position by 27% late last year? Institutional money, the big, boring money that stabilizes a stock price, hates opacity. Moving from Switzerland, the gold standard of banking and regulation, to the BVI looks like a step backward in governance.
That's an interesting point, though. I would frame the institutional activity differently. While Morgan Stanley trimmed, we saw Osaic Holdings increase their position by nearly 82%. There's a rotation happening here. We are seeing a shift from conservative, passive money to aggressive, event-driven funds who understand the arbitrage. And about the BVI move, it's about agility. The Swiss legal framework is notoriously rigid for capital reductions. It requires audits, waiting periods, creditor calls. The BVI move is explicitly designed to facilitate the distribution of those SPAC shares. It is a shareholder-friendly move disguised as an offshore play.
Or it's a way to avoid scrutiny while they bet the farm on quantum. Let's talk about the elephant in the room, the Quably acquisition.
I think this is the most exciting part of the thesis.
It's the most terrifying part. SealSquy signed an MOU to acquire Quably for a potential $200 million. We just established they have roughly $228 million in consolidated cash. Do the math. They're taking almost every dollar of available liquidity and dumping it into a French startup specializing in cryo-CMOS quantum processors. That's why the market panicked. It's not an arbitrage opportunity, it's a capital allocation crisis. They're transforming from a cash-rich holding company into an illiquid, asset-heavy R&D shop.
I see why that looks risky if you view it as just burning cash, but this is the deep tech arbitrage. You have to look at the synergy. SealSquy makes secure chips, semiconductors that go into cars, meters, payment cards. Quably makes silicon-based quantum processors. The goal is to manufacture quantum-grade security chips using standard semiconductor fabrication plants. That is the holy grail of the sector.
Holy grail usually implies something that is impossible to find.
But look at the peers. Pure-play quantum stocks like IonQ or Rigetti trade at massive premiums, with market caps in the $300 to $500 million range. Seals SQ is buying Quably to capture that quantum premium. They are buying their way into a higher valuation multiple. If they pull this off, they aren't a boring chip company anymore. They are a quantum computing play.
They are buying their way into a money pit. The sell the news reaction to the Quably announcement confirms this. Volume on the downticks increased immediately after the news broke. The market prefers the certainty of cash to the speculative promise of cryocemos. And let's look at the correlation with crypto markets again. You mentioned Polymarket earlier. There's a huge correlation between WKEY's price action and the sentiment around hacks and crypto-fearing greed.
Exactly. That correlation supports the bull case. Think about it. If Polymarket contracts on exchange hacks or bridge exploits rise, meaning people are betting the crypto security is failing, the valuation of quantum-resistant hardware should soar. That is exactly what SealScore and Quobly are building. It's a hedge against the rest of the tech market.
That's a very complex derivative bet you're asking a retail investor to make.
It's sophisticated, yes. And don't forget the SealCoin aspect. It's a deep-in play, a decentralized physical infrastructure network. As crypto sentiment recovers, which we're seeing in the early 2026 data, the value of that tokenized ecosystem rises.
That is a lot of ifs. If the SPAC works, if the quantum chips work, if the crypto market holds up. Meanwhile, let's look at who is actually trading this stock right now. The dark pool data is incredibly telling. We're seeing 40 to 50% of the volume happening off exchange.
Dark pools are just how institutions trade to avoid slippage.
Sometimes, but in a stock this size, that is not retail buying the dip. That is institutional arbitrage funds hedging the spread between WKEA and LES. They're likely long WKEA and short LES, or vice versa, locking in the gap. They aren't betting on the company's success. They're betting on the pricing era closing. As soon as that gap closes, they dump the stock. That creates a massive overhead supply that limits how high the price can actually go.
But that pricing error is the investment thesis, and the technicals suggest the smart money accumulation phase is ending and the breakout is starting. Look at the chart. WKE is trading 33% above its 200-day simple moving average, which is sitting at 697. In technical analysis, holding above the 200-day is the primary signal of a long-term trend reversal. We're seeing a breakout. Plus, look at the analyst coverage. H.G. Wainwright and Maxim Group have a consensus strong buy, with an average target of $11.49. Even the lowest target on the street is $10. That's a safety margin above the current $9 level.
Analyst targets on microcaps are often lagging indicators. They update those targets after the stock moves. I'm looking at the insider signals. Yes, insiders hold about 6.3%, which is decent skin in the game. But the complexity here is the enemy of value. You have a Swiss company moving to the BVI, listing a US SPAC, buying a French quantum firm, and dealing with a NASDAQ subsidiary. It's a governance nightmare. If that SPAC deal collapses or even just gets delayed, the stock is going to test that 200-day SMA you mentioned. A drop to $7 is entirely on the table if the convergence strategy hits a regulatory snag.
I disagree. The downside is cushioned by that massive cash position. Even if the SPAC fails, you still have $228 million in the bank. The market is currently pricing WKEY as if the cash doesn't exist. That's irrational. And regarding the insiders traditionally buy before SPAC spinoffs if they're confident. The high insider sentiment score we're seeing is a signal that they believe the BVI move will pass and the value will be unlocked.
Unless the cash is already spent on the Quably MOU. That is the risk. The cash floor is only solid if the floorboards aren't being ripped up to build a quantum computer. And let's go back to the liquidity one last time. With 260,000 shares trading, slippage is real. If you're a retail investor trying to enter this trade based on a sum of the parts theory, you're fighting algorithms that are snipping pennies in the dark pools. The non-exempt short volume suggests that there are players who believe this price is going lower, not higher.
But short interest is a double-edged sword. Total short interest is around 460,000 shares. That's about 3.3 days to cover. It's moderate, but if we get a definitive yes on the BVI vote or the SPAC merger closes, we could see a squeeze. The shorts are betting on complexity causing failure. I am betting on complexity masking value. This is essentially a publicly traded venture capital fund. You're getting exposure to space, quantum, and cybersecurity for a negative enterprise value.
It's a portfolio, I'll give you that. But is it a $600 million portfolio disguised as a $100 million company, or is it a value trap destined to burn its cash? The market hates uncertainty, and WKEY is pure uncertainty wrapped in a complex legal structure.
So, where do we land? To me, the data points to a massive dislocation. The upside case sees a re-rating to the $15 to $20 range if the BVI move passes and the SPAC holds its value near NAV. The math simply requires the market to acknowledge the assets that are already there. It's not about hope, it's about arithmetic.
And I come at it from a different way. The discount exists for a reason. The control discount and the execution risk of the SPAC justify the current price. If the SPAC trades poorly, which history suggests it might, and the Coolbly integration drags on, the stock could easily revert to that $7 level. Investors are being asked to hand a blank check to management for a high-risk quantum gamble.
I suppose that is the core tension. Is it deep value or a value trap? But we can agree that the volatility we're seeing in January is the price of admission for this asset class.
Absolutely. And for anyone watching this, keep an eye on those polymarket signals for space and crypto. It is pretty unique to see a stock price correlated so heavily with prediction markets rather than just earnings reports.
The answer lies in the execution of Q1 2026. Whether it's a $100 million company or a $600 million portfolio, we are about to find out.
Indeed. Proceed with caution.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya!